All right. Good afternoon, everyone. Thank you for joining us. This is our Q1 2026 webinar. I see a few familiar names that joined us earlier this week when we did a different seminar about estate planning. So thank you, everybody, for joining us for that as well. We've got our usual crew here today. My name is Kyle Kite. I'm one of the advisors here, and I'm joined by Josh Sterling, our Chief Investment Officer, and Eric Schwartz, another advisor up in our Madison office. So again, thank you everybody for joining us. Let's get this thing started. Okay, so those of you that have been with us, this slide probably looks fairly familiar. So this is just an update on where we are by the numbers as of the end of the first quarter here. So you can see that the big number that we like to focus on here is 50 years in business this year. So actually next month is officially our 50th year in business, which we are super proud of. Being a small business that started down here in Rockford, Illinois, and obviously have expanded to Madison. There's not a lot of small businesses that make it 50 years. So we're very, very proud of that. We serve over 1,100 households now, and we have 25 employees, and we have people in 34 states, believe it or not. So it's always neat to check in on these numbers and see how they change quarter over quarter.
Yeah, we've all three of us been here for 50 years.
Yeah.
It's very
Exactly. Go ahead, Josh.
All right, so I'm going to be starting with the economic update here. And we were just kind of talking. It's always interesting to do these webinars about a month or a few weeks is really all it takes after the end of the quarter, because so much can change in that time. But we're going to be talking a little bit here about what we've seen here in the first quarter. We entered Q1 actually on pretty stable footing from an economic standpoint, largely on the back of really strong labor markets especially in the developed world. And also, the phrase we can't stop hearing, AI investment, lots of capital expenditure going into that and fueling economic growth. That all kind of changed direction, deteriorated towards the end of February when the conflict in the Middle East began. And really, I mean, I feel like at this point we're all seeing it every day, and there's different updates and all sorts of different directions that we're told things are going. But really what happened here is we had a huge disruption to energy markets, and that increased concerns about inflation, which also caused just general market volatility. And I think for the last few years now, we've been talking a lot about inflation and how it impacts interest rates. And really this was kind of as we started on a stronger foot, it just really seemed to turn pretty quickly here towards the end of February. The International Monetary Fund lowered our growth expectations for the year at a global level, and overall we've still seen some growth here in the first quarter, but it's just been really slowed for the most part. And I think overall things just feel a little bit more fragile than they did just a few months ago. Yeah. And then just here in the last few weeks, we look at unemployment numbers that actually are holding pretty steady. So we're getting a lot of mixed messaging, largely because I think we're getting so much news so quickly, and it's really difficult for the market and the world to kind of digest it so quickly.
I feel like the major thing that everybody's paying attention to, of course, is the image that we have up on the screen, which is gas prices.
Yeah.
And just the fallout that we're seeing from energy prices going up has been quite drastic. But it's not only being seen here in the U.S., but it's a global impact to this huge supply chain and this sudden huge outflow of oil that is just completely dried up. It's very much so impacted very quickly a lot of the markets across the globe.
Yeah, we'll talk more about that in a second here, but we tend to, because we see it every day, we think of the impact of the every day going to the gas pump, but it goes even further beyond that, especially when you get into other parts of the world. So let's talk a little bit more about that here. Um, so we call it geopolitical uncertainty here, but I really think what we're talking about is the continued conflict, war, whatever we're calling it right now, um, based on the status. But it is basically the activity that's happening right now in Iran. And as I mentioned earlier, it really has disrupted oil transport, specifically through the Strait of Hormuz, which is a waterway that I'm sure a lot of people had not heard of just a few months ago, and now it feels like everyone's kind of an expert on supply chain for our global energy markets. But this the lack of ability for oil to be shipped through the strait has driven up prices, and it has really caused the Fed to pause and think about whether or not they're going to have to delay some expected interest rate cuts, which again for the last few years we have been talking extensively about. The Fed wants to see inflation moderate, the market wants to see rates go down, right? So anytime there's concerns about increasing the cost of goods, where the Fed and the market get pretty concerned. And it's not just us going to the gas pump and seeing that gas prices are higher, but it's the fact that all the goods that we buy, if they have to be shipped, they are generally shipped on something that uses fuel or energy of some sort, which can help drive up the price of those goods as well.
Mhm. Yeah,
Um, I think the last piece sorry, Kyle, you want to jump in here?
no, I was just going to say the biggest thing here is uncertainty. And you guys have heard us talk about this all the time. The stock market does not like uncertainty. And that's what leads into some of these, the market going down, for instance, in the month of March was just, again, the market's trying to figure out exactly what's going to happen, how this is going to impact everything and that kind of stuff. And over the last couple of weeks, it looks like the market feels that it's not going to drag on forever or anything like that, because we've had a nice little rebound in the market. But again, like I said, the biggest thing is just the uncertainty. The market's trying to predict what's going to happen in the future. And anytime a wrench gets thrown into that, that's where you see volatility like this.
Yeah, and it tends to build on itself, right? I mean, it starts with, well, what if the Fed doesn't drop interest rates like we had hoped or expected? And what if that, increases the cost of borrowing and investing for businesses? And then, as we watched the first quarter wrap up, we really saw kind of a regional effect of the geopolitical uncertainty, because, different parts of the world fared better or worse, largely based on their energy situation, whether or not they are importers or are exporters of, in this case, oil. China had a really good first quarter, a lot of growth. I think they were over 5%. They beat expectations in the first quarter. But then if you look at Europe, and you look at other countries or regions that are having to import oil, right? You look at those places, and they really stagnated through the first quarter. And one thing that I think the world is going to be watching a lot is how long these prices stay elevated, and what sorts of impact they have on some of these smaller emerging economies. Many places where the government provides fuel subsidies, and if the costs remain elevated for too long, that's really going to have an impact on government spending, and just have a ripple effect down the road.
Mm-hmm. Absolutely. Well, before we jump into kind of the next set of data we're going to look at, I do want to kind of frame up the discussion a little bit. So as we're kind of talking through this, wars, conflicts, of course, have severe negative consequences for humanity as a whole. Lives are lost during these. Infrastructure is destroyed. People are negatively impacted, being uprooted from their lives, whether their homes destroyed, they have to literally leave their countries. These are really serious things. You already hear about this nonstop from other sources, whether it's news, your community. We also hear it, and we understand the fear and pain that everybody else is hearing. However, we do have to look at what our role is here as financial planners, investors. We really need to kind of take a step back and we have to really look at this and say, how does this impact our clients' plans and investments? And it might seem a little too black and white, might seem a little brutal at first, but we need to look at how individuals react behaviorally, emotionally to things that happen in the markets. And we have to take that viewpoint to really make sure that we look at the facts, we understand what's happened in the past, and help make sure that our clients are on the best path forward regarding how things happen.
Yeah, and I mean, we're not here to be the arbiters of right and wrong or what's good or bad. We're here to help people kind of guide them through turbulent times like this. So we are going to spend a lot of time just talking about history and you know how the market and the economy has responded to things in the past.
Mm-hmm. So looking at this next slide here, we're taking a look at a handful of events that have happened over the past 20, 30 years here. And we're looking at it from the perspective of how does the market react to wars, conflicts, events that happen historically. And we could go back to the early 1900s, and we're going to see very similar things that happen with what we're going to discuss here. But the information that we're looking on the screen, we're looking at the market returns 3 months before an event happens. So 3 months leading into that event, the 3 months directly after that event. And then we're going to look at slightly longer time horizons, 1 year after, and then 3 years after. We look at that in an annualized basis. Now, I'm not going to go through every event on here. We have them on here as examples to look at. But I'm going to focus on 2 here. So we'll kind of chat through September 11th and Russia invading Ukraine. And really, there are a couple of big kind of takeaways that I'll kind of bring to everybody's attention before we kind of dive into the information. Markets react in the short term. They react to uncertainty, like we've already talked about. But given medium term, long term outcomes, markets typically react to fundamentals. They look at earnings growth. They look at monetary and fiscal policy, how they're responding to the events that are happening in front of them. Are they going to support the local economy? Or are they looking at global events? How is inflation and interest rates impacting individuals, and are energy prices sticking around? So while wars and conflicts can cause this temporary volatility that we've seen over the past month, the market generally reacts to longer term horizon events once they see clarity in the market. And the big thing that we'll come back to is really what is happening in the economic backdrop, not only just the event that's happening, but what else is happening around that event. And so looking at some of these events specifically, let's start with September 11th. 3 months prior to September 11th, we're coming off of a pretty brutal time. We had the dot-com bubble burst happen in the year 2000. We are basically starting a recession around this time. In the summer of 2001, you had corporate earnings dropping down. You had the Fed cutting rates, trying to support the local economy. And then you had equity markets trending down, and that's that negative 14% that you see there. We were already on a rough footing leading into that moment. And you can see the 3 months after, up 5%. And you might sit here and think, oh, that's kind of shocking that we returned positively after the September 11th attack. But the market did have a short-term reaction. Right on the day of September 11th, the US equity markets didn't even open that day. The New York Stock Exchange and the NASDAQ didn't open for 4 days. And then once the US markets opened back up, the Dow Jones opened on September 17th, down 7% by the end of the day. And it was one of the single worst days in the stock market in history. So you really see that you had that short-term volatility with something monumental that happened. Markets did react, but once you kind of get past that time, 3 months is still a short time frame, but the market was able to kind of see through what was happening in that event and rebound a little bit. But the bigger impact here, when we look at the 1 year later, down 12% during that 1 year time frame, is really that economic backdrop that is happening with the recession. You also had Enron collapsing during that time frame. Scandals were being revealed. Corporate America was going through a rough patch in 2001, 2002. So again, while that event was meaningful, impactful, the market was really looking at that economic dropback of what was happening in the US. And we can see that 3 years later, looking at that annualized return of 5.5%, the market was able to kind of see through that time frame and see a rebound in the market, looking at that longer time horizon. So we see that volatility in the short term, but generally given a long enough time span, we see that stock markets rebound a little bit. Now, we also see this happen kind of with Russia invading Ukraine. We saw similar events play out where leading into it, we're coming off of COVID. Inflation was beginning to rise. Discussions of interest rates beginning to increase was happening. And it was somewhat being illustrated that Russia could invade Ukraine. It was somewhat known that it might not be a surprise thing. We do see the event happen, and then still 3 months later, we see negative markets. There were a lot of things that Russia invading Ukraine led to things that really impacted globally there. Russia exports a lot of oil, natural gas. So energy markets got hit pretty hard. Ukraine exports food. So you saw inflation starting to increase outside of there. Russia was also deemed uninvestable. These were some things that had multi-year time spans that could really heavily impact markets. But we still see 3 years later, markets were able to kind of rebound, see through what was going to happen, even though the event in the moment was pretty rough.
Yeah, I think just by the very nature of these events, they tend to dominate the news cycle. But I think what you can see here is the economic fundamentals are generally going to win out over that short-term volatility that is caused by the fact that this event is dominating the news cycle.
Oh, yeah. So let's go ahead and take a look a little further beyond here. Bear with us for a moment while this slide loads. Might take a brief second. So wars and conflicts are not the only thing that happen in history that impacts the market. There are many events that impact market returns. And in moments, it can seem like everything's falling apart. How on earth could the market recover? And you hear this left and right. But really, history shows that this is a normal part of investing. Events are going to happen. Markets will react. But given enough time, we will see that markets rebound. Markets generally have a positive trajectory, and events will fade into the past. While all of these are important and, of course, seem wildly important in the time, we really see that overall markets have general support over a long enough time frame. All right, Kyle, why don't we take a look at this with our individual portfolios?
Yeah, thanks, Josh. So again, this is just looking at basically the last 3 months or so, going back to December of 2025. You see here, and we just use 10,000 to make the math easy to see. But you can see that through the end of last year, we were kind of going up, and then through January and February of this year, it continued to trend higher. So before the March breakdown with the whole Iran thing that we've just talked about, the market was actually in a pretty good spot. Most of the S&P was up about 5 or 6% at that time. Most of our clients in the 60-40 portfolio were up a couple percent, 2 to 3%. And then you see the big sell-off there through basically the whole month of March was down. But why we say that it wasn't really as bad as people thought it was, because you were coming off of 2 good months up. So even though we got close to that official correction territory, which which is a 10% drop. Your portfolio, assuming you're in a 60-40 or even a 40-60, honestly was down, 1 or 2% kind of at the low point from where it started the year. Because again, you've got to take all of this into consideration here. And if we were to stretch it out over these last 2 weeks, people are actually back to positive now. So it's been, again, a round trip. And honestly, as good as last year was, everybody remembers we had the Liberation Day, trade war, tariff stuff all broke out in March. And at that point, the S&P was down over 15%, but then it finished the year up somewhere around 17%. So these, corrections, 10% corrections actually happen quite often. What causes them changes, of course. But again, what's been interesting about this one is you can see it kind of went down on an escalator, which is the opposite. Usually the stocks go up on an escalator and then down on an elevator, where this time it was actually down on an escalator and then popped back up fairly quickly over the last couple of weeks. So it almost came up on an elevator type scenario. So again, it wasn't really, unless you were tracking this on a daily basis, which of course we don't recommend people do. Most people seen their February statement and, oh, I'm up. And then they didn't look at it again until March and, oh man, I'm down again. And then that's when we get a couple phone calls. And over the last week here, because you got it through the mail or whatever the case is, it's, well, actually now it's actually back up to even, or now, like I said, over the last week, it's actually gone positive for the year. So again, it never feels good when you look at those statements and see it go down, of course. But again, taking the whole thing into context, it's actually has not been all that bad of a start to the year. And like I said, we're actually back up to where we were at the end of February. So
I think sometimes it's really hard when you hear all the news and all the headlines going on to really look at a graph like this and say, oh, well, my portfolio was $10,000 back in December. That's a tough thing to come to reality with when all you hear is stock markets are down, stock markets are down. But the reality is that the S&P 500 hit a new all-time high today, and you don't hear too much about that happening.
Well, and I think it also has a little bit to do with the different asset classes and what we might call diversification within the portfolio.
Absolutely.
Good tee up, Eric. So yes, again, this was again through March 31st. You can see that, the way that our portfolio is broken down, as we've talked about it at length, is that globally diversified asset allocation. And what you'll notice is through March here, the only two sectors that were actually down was corporate bonds were down slightly at 0.3%. But really, it was U.S. large caps, which again, these are kind of your mega corporations that you think about. But everything else was, again, kind of holding its own and actually up quite a bit, which is good to see. So again, this leads into why it wasn't as bad as what the headlines say if you looked at your own individual portfolio, because the headlines focus on the Dow Jones and the S&P 500, which is basically all U.S. large cap stocks. So all you heard about was this negative 4.3% piece of the pie. You don't really hear about international and emerging on the nightly news and that type of stuff. And again, this just goes to show that, last year we talked about it. Part of the reason why returns were so good for our portfolios was international stocks really outpaced U.S. stocks last year. And so far in the first quarter of this year, that's continued to be the case. So you're getting that benefit of diversification.
And I think that this is really one of the core elements of our investment philosophy here, is it really ensuring that we have that full broad diversification. We'll hear comments occasionally like, oh, why am I invested in international markets, emerging markets specifically? And it really comes down to that full diversification. US markets have been really positive for quite a few number of years, but we've now seen international markets perform very strongly over the past couple of years, outpacing the US markets. And it's basically the whole point of diversification is not that we're trying to hit a home run every single year. We're not trying to predict, hey, this asset class is going to be the best, so we're going to go 3 times higher than what we would traditionally hold it as. We're really trying to provide strong diversification through global equities, through bonds, so that clients can try to have a more predictable outcome with how stock markets and bond markets react to events, and to help them plan for the financial future.
Yeah, and looking at the different asset classes here, I don't think our clients often see the it broken down more than just stocks versus bonds or equities versus fixed income. But this to me brings to the forefront something that happened here over the last month or so. Folks probably saw some more trading than normal going on in their portfolios. And that was largely a result of some portfolio large scale portfolio changes that the portfolio management group made. So since we have the chief investment officer here on the call, I thought maybe you could tell people a little bit more about that.
Yeah, definitely. We're really excited to be rolling out some new portfolio changes. Well, we're excited. You saw some trades in your portfolio. There's nothing relatively new and shiny about our philosophy. It's the same old. But again, focusing on global market cap exposure, making sure that we're using low-cost index solutions, making sure our clients are fully diversified. However, that doesn't mean that we should hold the exact same investment for the entire time frame. New things are developed all the time. Competitors are out there, and we want to make sure that we find the best solutions for our clients at all times. And so I'll raise attention to three new vendors, essentially ETF providers that you'll see within your portfolios: Dimensional, State Street, and Vanguard. All three of which had changes over the past couple of years or maybe a little bit longer, where it really made sense to get them involved in our clients' portfolios. So on the US side, State Street has become incredibly competitive with cost, while having one of the most remarkable tracking errors to the S&P 500 and the S&P 600. For those that care, this is a very, very interesting thing that we watch very closely. We want to make sure that we get the best solution with the best possible outcomes. And they really provided a solution that cut cost by about 10-15%, which doesn't sound like a big deal, but it's a big chunk of the portfolio. When we look at Vanguard, we were able to swap out our US Treasury exposure, which was previously for most of our clients was at 0.15%. We were able to have that come down for the expense ratio all the way down to 0.04, which is a huge cost savings for our clients. And then finally, Dimensional. We've been watching Dimensional ETFs for a while, but they were relatively new, long-standing company that we've really enjoyed. They typically have mutual funds. We usually engage ETFs. And about 5 years ago, they started deploying ETFs. We wanted to take time, wait until they became stable, they had enough money built up in them. And once we determined that it was an appropriate time to utilize them, we started utilizing Dimensional in our international holdings. They've been a great partner, and we're very excited to have them in the portfolio, especially as they're such an efficient and effective way of accessing international markets. If anybody has additional questions on that, you can always feel free to chat with us. We don't want to overwhelm people with information, but it's exciting. It's great changes. We're excited that the landscape is always changing and that we can take advantage of better pricing, better products, and just really deliver a good solution for all of our clients.
Kyle, I think we might have some clients out there that are grateful that we're there to translate. Josh is very intelligent.
Exactly right.
I'm just kidding.
Yeah. It's super important though. That's the thing, is that, we want to have people like Josh on our team and have him talk on these types of forums, because that's what this call is for, is to get a little more into the weeds than just what we talk about in a normal review with our clients. And that, yeah, sometimes we downplay investments a little bit, but it is super important, and it is very much looked at very closely by our team to make sure that we continue to bring the best portfolios forward for our clients, because obviously we want to have the best chance for successful outcomes and those types of things as well. So,
all right.
With that, we'll open it up for some questions. If anybody would like to use the Q&A function down at the bottom, that would be great. But it looks like we've got a couple. So Well, one was headlines are constantly showing the market's down. How is it possible that we're slightly down since the start of the year? We kind of talked about this. It was really diversification is why you didn't feel it as bad as what the headline showed. But also just give it a couple weeks and now it's actually back positive for the year. So, but the other one, I'll turn this over to you guys here is why are interest rates rising on mortgages when my savings accounts are staying stable?
I think this is a really, really good question because interest rates you would think would be more simple than they are. The Federal Reserve hasn't changed interest rates in a hot minute, and yet mortgage rates seem to be going up slightly. And it's an interesting aspect because when you're looking at your bank savings rate, you're looking at something that is very short term. They're giving you monthly interest, and you can take that money out whenever you want to. So that you're typically going to get a pretty stable value. That is really reactive to what the Federal Reserve does right now. But when we look at things that are longer dated, 10 years, 30 years, mortgage rates specifically, well, those companies that are giving out the loans have to consider more than what is the Fed doing right now in this moment. They're looking at, okay, well, current interest rates are at this amount. We think it may go up to this amount in the future. Oh, and by the way, generally a 20, 30-year loan is going to have a higher interest rate than shorter dated ones. And so when you start adding in all these different elements, all these different events that may happen, these projections that are happening, well, you're going to start noticing that gets pretty fuzzy. Things are a little bit more uncertain. So when different news events, different news pieces come out, information changes, you're going to see that moving a bit more dramatically. So it's unfortunate that it's not as simple as just the Fed lowered interest rates, therefore mortgage rates are going down. It really involves a lot more information and things that are going on in the background.
Mm-hmm. And it ties into the overall US economy. So we kind of talked about this at the beginning of the call too, but there's the economic factors are what play into mortgage rates as well. Like Josh said, not just the overnight Fed funds rate and that kind of stuff. And as we said, from where we were a couple months ago, not much has changed in the economy. We're still growing, but slowly. We're not growing 3% like we were, a year ago or so. But you're also not seeing massive layoffs across the job, the spectrum yet, which, if you ask us what's one thing that we're paying super close attention to, it is that job rate. Because if you were to see some mass layoffs, that's probably not going to be a good thing for the stock market. So we haven't seen that yet, which is, again, why the market continues to just kind of trunk along here over the first few months of the year here.
Perfect. All right, Kyle, I think we got a question that came in. Can you provide a simplified summary of the changes you made to the portfolio recently and why? So I'm going to let one of you take a crack at what I said, see if you can make it a little bit more simplistic.
Josh, I thought it was very simple, but no, I'm just kidding. So one of the things that we do on behalf of clients is make sure that the investments that we use in your investment portfolios are the best options out there for you. They are the most cost effective, they're the most efficient, and the most attractive just from the portfolio that we build for you. So from time to time, there are going to be new investment types out there that we can use that are more efficient, more cost effective, and better for our clients at the end of the day. So one of our major goals as a firm is to make sure that our clients have broad diversification to the global markets. So we try to find funds that for a very, very low cost can give you large, broad exposure to global equity markets. And so as the available investments evolve, we are always going to be looking for the best option for clients, and we'll make changes as we need to.
Mm-hmm. Absolutely. Yeah, we have an investment policy committee here in addition to our investment management team. So we have some advisors that join in on that. And so we're all involved in the decision-making process of what are the most appropriate investment options. Are these doing what we intend them to do? Are there any new options that come out? So we have a big support system for making these decisions and ensuring that we're doing what's best for our clients.
Yeah, and I think if you make this, maybe if we look further back and make this a little bit more of a dramatic change, it might make more sense. You know, not too long ago, you couldn't just, open an account at Schwab or Fidelity and buy a stock. You had to call a stockbroker, right? And they had to buy it for you. That was the only way you could access the market, right? And then we moved into we have mutual funds and annuities and eventually exchange traded funds. And now there's all sorts of complicated different investment vehicles out there. Well, if you look at the way that you can access the market and choose investments for clients, it changes really, really quickly, like far more quickly than I think people expect. So part of our job is always to be on the lookout for the most efficient, lowest cost way to access the market for clients.
Yeah. It might be cool, Josh. Maybe for one of these, we show how many new ETFs get issued each year, just so that clients can see how many options come out on a regular basis.
There are a lot coming out right now.
Looks like we got another question coming in. You want to go for it, Josh? You want to read it?
Yeah, I'll read it out. So, some insights on your planning process, please. With talk of European airlines shutting down some routes soon, it appears petroleum shortages are beginning to bite. If oil takes a run at $170 a barrel or 200, what are you thinking about? So I guess, how do you guys view this from a planning perspective for individuals? I think we talked about it a little bit from a market's reaction standpoint and whatnot, but what are you both doing inside client planning meetings to kind of chat about this?
Well, I think just to sort of set the stage here with the question, I think that it's fair to say that I wouldn't even say it's petroleum shortages, like specifically somewhere like Europe. This is, I mean, airlines everywhere are doing this largely as a cost-cutting measure because number one, maybe planes aren't full, and number two, fuel prices are higher, so they are just being more being stricter with how they approach it. They approach capacity and trying to maximize profits as much as possible for shareholders. But I think probably what the question is getting at here is what are we changing on the investment side, I would imagine, is where the question is coming from. Our financial planning process is not really going to change much at all related to higher fuel costs. The only thing I could see is, if people are thinking twice about taking a long trip that maybe they were planning to do. Although we really build the financial plans to be flexible enough that people don't have to make really short term, don't need to change their behavior just based on short term market impacts. Mm-hmm. Kyle, was there anything you'd add to that?
Not from a planning perspective. If oil were to go up that high, that's probably going to have some severe impacts to the consumer because you start spending that kind of money for, plane tickets are already expensive. That would just ramp them up that high. So you're probably going to see a slowdown in travel, but just your week to week, people not going out and spending as much money, you're probably not going to take that weekend trip if it costs you $300 in fuel versus $100 in fuel, right? Consumers would be impacted and they would have to start tweaking their budgets around those higher fuel costs when it comes to that kind of stuff. And that would show up in economic data at some point. But as Eric said, from your personal financial plan, it would be more like budgeting specific stuff. Hey, if our fuel costs go up this much of our budget during the month, what are some other things that we can tweak? Or do we have to take a little bit more money out to, meet our needs and things like that? But like I said, it would be much more of an economic impact or something like that would influence probably the overall market if it were to get to that level, I would assume.
Yeah.
And I think, sorry, last keep
Mhm.
jumping in here. Last thing I'll say is when things are as drastic as like $200 a barrel oil, that by their nature, they tend to be short-lived. Now, that's not just as an example, a really, really extreme event is generally not able to persist for a great amount of time, which does then lessen the impact overall. But I'll bring it back to you, Josh, here.
Yeah, from the other perspective of what are we doing inside portfolios to kind of combat this, we view portfolios as something that needs to be globally diversified, something that is not reactive to momentary events. Like Eric said, if a monumental event like that happened, generally is going to be relatively short-lived, and it is theoretical that that could happen. If we go ahead and we were to react and sell out of equities for the sake of equity markets may come down in the future, that is a level of timing the market. And timing the market is a losing man's battle. Not only do you have to predict what the markets are going to do correct on the first time when you sell out, but also on the back end when you get back into the markets. And I know it's not like looking at it from a light switch on and off, but in a similar nature, trying to predict the markets, trying to position the portfolio to be perfectly aligned to battle what's going to happen with oil prices becomes a very, very difficult thing where there are so many events or so many things that feed into that overall price, and our market's going to react the way that you expect them to if that even persists over a long period of time. That is why we really focus on more globally diversified, rules-based philosophy. We do not make emotional decisions around portfolio management. We really focus on looking at risk perspective for each individual client and making sure that clients are set up correctly with their individual portfolios. Yeah.
Yeah, and I think the reason, maybe this goes without saying, but I could hear someone saying, well, if you're not trying, why aren't you trying to time the market, or why are you focused on this other way of rules-based investing? It's not because timing the market is hard. It's because historically, being rules-based, globally diversified investors has paid off, right? So that is why we believe this is the best way to approach investment management. Not because it's easier. In fact, in many cases, it can be harder because you have to make hard decisions. But historically, this is what has delivered results for investors.
All right, perfect. I think that's the end of the questions that we have here. So thank you very much, everybody, for joining us here today. We appreciate all the questions that came in, and we'll look forward to seeing everybody in about a quarter.
Thanks, everybody.
Thank
Bye,
you.
everyone.
Bye-bye.